welcome back. Today we are looking at a financial analysis report on Datavault AI, or DVLT.
And specifically, their pretty stunning announcement.
It is a 400% hike in 2026 revenue guidance. They're going from $50 million to $200 million.
All driven by this pivot into real-world asset tokenization and that huge $150 million strategic deal with Silex Holding.
It's a massive shift. The analysis captures the excitement for sure.
Oh, absolutely. But when a company, especially a microcap, does something this big, the market's skepticism is going to be, well, intense. The arguments have to be rock solid.
So the core of this whole thing is that qualitative shift, right? Moving from data sales to RWA tokenization.
Exactly. And the analysis nails that part. It identifies the shift as the engine for the guidance height.
But the market needs more than just a good story.
It needs justification. So I guess my first question is, how well does that qualitative shift actually support the $7 price target?
Which is where we get into the valuation.
Right, because I think the analysis successfully identifies the shift to real-world asset tokenization as the reason for the guidance hike, but it fails to really use that qualitative change to robustly defend the $7 price target.
And if you look at the valuation segment now, it does feel a bit, well, like napkin math.
It's a little simplistic.
It points out the current 2.9x price-to-sales ratio, compares it to some high-growth peers,
Who are trading at, 10x, maybe 20x.
and then it just sort of lands on a modest 5x multiple.
And that's the weakness. That argument feels completely disconnected from the main story.
From the RWA pivot.
Exactly. You can't just generalize from AI stocks to justify a big multiple expansion in a report like this. Investors need to understand why this new business model specifically earns that uplift. Why is it a 5x business, not a 3x?
So the reasoning is circular. The pivot justifies the revenue, but the valuation doesn't connect back to the pivot.
Precisely. So the suggestion here would be to re-anchor the entire valuation discussion. You need to explicitly explain the economic superiority of the RWA model over the old data sales model.
And use the specifics of the RWA market itself to justify that multiple.
Yes. You have to translate the pivot into valuation language. Talk about earnings quality.
Okay, so for example?
Well, what's the difference in gross margins? The old data sales model was probably transactional, maybe lower margin.
One and done kind of deals?
Right. But this new RWA platform, does it operate on a high-margin, sticky, SaaS-like model? Is it based on recurring platform fees?
That's a huge distinction. If the contracts are sticky, the market will pay up for that. Predictability is everything.
It really is. And that's what the analysis has to spell out. If these new contracts involve tokenizing, say, long-duration assets like infrastructure or real estate portfolios,
Then the revenue is far more predictable than standard data licensing.
and that stronger, more predictable earnings quality is the real driver. That's what justifies jumping from a 2.9x PS to a 5x.
So the analysis could also add more context, like if there are any pure-play RWA peers out there, cite their multiples.
You have to. It grounds the argument in reality. And if there aren't any, then compare it to established enterprise SaaS companies with similar recurring revenue profiles.
Even if they're in a different sector.
Yes, because it shows the analysis understands the mechanics. You're valuing a platform, not just a promise.
Okay, that feels much stronger. So let's move on. The size of this announcement, quadrupling guidance, it just invites a counter-argument.
It screams for it.
In the current analysis, it mentions volatility and execution risk, but it's very brief.
Yeah, that's my second point. For a microcap making this kind of claim, the risk alert section is just too brief and generalized.
It comes across as a bit unbalanced.
It does. It risks underestimating how skeptical a sophisticated investor is going to be.
And the weakness here is pretty clear. While it flags the right things, like the risk of hitting that $200 million target, it's superficial.
A 400% revenue increase is by definition highly speculative. The analysis has to get in front of that. It needs to identify the biggest threats and talk about mitigating them.
The first question any cynical investor asks is, how will this fail?
Exactly. And the report needs to have a good answer. So the suggestion is to really expand that risk analysis.
You're saying it should specifically address the operational hurdles of entering the RWA space?
The operational and competitive hurdles, and also the structural risks of that big Silex deal. By doing that, you actually make the bull case stronger.
Okay, let's break that down with some examples. What's an operational risk?
Well, the report mentions building out supercomputing infrastructure to service dozens of contracts. That's a huge, immediate challenge.
A massive capital expense.
So the failure point is specific. Can they actually get the specialized hardware, the energy capacity, the talent to run it all fast enough to meet demand?
You could flag things like the ongoing chip shortages.
Yes, or the scarcity of specialized data center engineers. You name a tangible bottleneck, and then explain how DVLT plans to mitigate it. Maybe they have pre-secured contracts with suppliers.
That changes the frame entirely. It's not just this could fail. It's we know this is hard, and here's our plan.
Exactly. It shows diligence.
What about competitive risk? RWA tokenization is a pretty hot area.
It is. So the analysis needs to ask, is Datavault really unique here? Or are bigger players, banks, crypto exchanges, cloud providers, getting ready to jump in with way more resources?
That's a great point. How does DVLT protect its edge against a giant that could offer this as a white label service?
The report has to address that. And then there's the financial structure risk in the Silex deal itself.
Right. The report frames accepting Bitcoin as a positive, that it removes bankruptcy risk.
Which is true and important for a microcap. But holding that much Bitcoin on your balance sheet?
Introduces a whole new set of complex risks.
That's right. You have massive mark-to-market volatility. You have some pretty unfavorable accounting rules from FASB for digital assets, which can wreck your quarterly earnings statements.
And just the general regulatory uncertainty.
Addressing that level of complexity shows the analysis understands the two-sided nature of the deal. It builds instant credibility. It shows you've thought through the really tough questions an institutional analyst will ask.
That makes a lot of sense. And speaking of that Silex deal, I feel like its role in the story isn't totally clear in the current flow.
I agree. It's presented mostly as a financing event, something that provided a war chest.
Which, again, is important.
It is, but the report misses its essential function. The structural purpose of that $150 million deal is presented mainly as a way to remove bankruptcy risk, and it overlooks how it's the strategic enabler of the whole RWA pivot.
The current flows sort of suggest the guidance hike happened, and then, oh, by the way, the Silex deal provided funding.
Like it was an afterthought.
And that weakens the credibility of the guidance. I mean, they couldn't possibly hit $200 million without that 150.
That's the missing link. The report misses the chance to tightly connect the capital to the feasibility of the RWA contracts.
It's not just money. It's the key that unlocks the whole plan.
Right. So our suggestion is to integrate the Silex deal as the operational prerequisite for the guidance hike. You have to position that $150 million not just as a financial buffer, but as the specific capital needed for the technical foundation.
That's a really actionable shift. So you'd recommend reordering the narrative a bit?
Or just emphasizing the connection more strongly.
Something like, the move to RWA tokenization demands massive computing power. The $150 million Silex investment is the direct operational green light, providing the specific capital needed to build out the infrastructure to handle $200 million in RWA contracts.
Yes, exactly. You emphasize that the deal is the validation that management is funded to execute. It shifts the focus from just removing liquidity risk to providing tangible operational capacity.
When you're promising that kind of growth in a capital-intensive business,
the market cares less about whether you'll go bankrupt tomorrow and more about whether you physically have the means to deliver.
It's a subtle change, but it's critical. The deal isn't just a line item. It's part of the execution story.
It makes the $200 million target seem much more credible because the capital's already there.
It ties everything together. The pivot, the capital, the capacity, the guidance. It becomes one logical loop.
And it validates the entire thesis of the report.
Excellent. This has been a really useful deep dive. To recap the key suggestions for making this analysis report as impactful as possible, we focused on three main areas.
First, deepen that justification for the valuation multiple. You have to link the 5xps target directly to the better economics of the new RWA model. The margins, the predictability, the stickiness.
Right. Get away from just comparing to generic AI stocks.
Second, you need to strengthen credibility with a much more specific risk analysis. Detail the operational hurdles, like scaling that supercomputing infrastructure, and also the financial risks of holding crypto on the balance sheet.
And finally, clarify the strategic role of that Silex deal.
Yes, position that $150 million not just as a financial safety net, but as the direct, necessary operational enabler required to actually build the capacity to hit that huge $200 million revenue target.